Good morning. Welcome to the Greater Milwaukee Foundation's fourth quarter investment briefing. My name is Anne-Marie Baumgartner, Senior Director of Donor Services. I have the honor of leading our team of philanthropic advisors and managing a portfolio of donors. Today, I will be your host for this investor briefing. A big thank you to viewers who took advantage of our last two on-demand investor briefings. We're so pleased to be able to wrap up this year with a live virtual event. While we will allow for folks to join in here, a little housekeeping about today's webinar. You may want to close other browser windows on your computer to improve connectivity while viewing this event. We will get rolling here soon, but feel free to enter questions using the interactive feature at the bottom of your screen, or if it's easier, you can text your questions to 414-335-1871. We'll get started in just a couple of minutes.
Thanks, Anne-Marie. And thanks to all of you who joined us this morning for our fourth quarter investor briefing, as well as for your partnership with the Foundation on your philanthropy. It is essential that we do this work together. And in that spirit, I'll be providing an update on the Greater Together campaign, a historic and ambitious fundraising effort that started quietly in 2017 and was launched publicly in 2022. This campaign provides an opportunity for our community, including our generous philanthropic partners like you, to catalyze generational change and work toward our shared vision of building a Milwaukee for all. Our comprehensive $700 million goal aims to help us strengthen the community through the leadership of our donors and their giving to so many excellent organizations and causes. The campaign also has a distinct focus on advancing racial equity and inclusion on a scale greater than ever before. We are in the final months of the campaign, which will close on December 31st of this year. To date, we have received gifts and commitments of nearly $665 million. That is worthy of celebration. We are grateful to all of you who have entrusted us with your resources to make Milwaukee a better place for everyone. And as you know from personal experience, the Foundation has worked in and with community for over a century, helping donors achieve their greatest philanthropic impact, elevating the work of change makers across neighborhoods, and bringing people and organizations together to help our region thrive. With racial equity and inclusion as our North Star, the Foundation is at the center of solutions, ensuring we invest in what Greater Milwaukee wants and needs. This also means being more inclusive, collaborative, and impactful, inviting you as current donors to join us in investing in critical issues from mitigating those issues to solving the root causes of problems facing our community. And we do so through innovative tools and collaborative solutions. This also means broadening our tent to welcome in new donors, to make sure donors of all backgrounds have a seat at the table. The campaign's priorities offer our community clear avenues for collaboration and contribution to the Foundation's mission and our shared vision. They reflect the critical issues our region faces based on research, community insights, and our board's vision, as well as the tools needed to drive impact in those areas. Alongside supporting donors in realizing their wishes, we're focusing $50 million of the $700 million goal to support the following 5 key priorities. The Thrive On collaboration, in partnership with the community, the Medical College of Wisconsin, and Royal Capital, we are creating a new model to address interrelated health, economic, social, and racial inequities through deep partnership in Bronzeville and investment that centers resident voice. You'll hear more about the great progress we're making on this from Senior Director of Thrive On Guest Experience and Strategic Partnerships, Sydney Key, later in this presentation. Early childhood education. The foundation's strategy, in concert with partners, will transform early childhood education in our community so that every child has the best start in life. Housing. Everyone needs a safe, affordable home because housing is a major building block of life, health, and wealth. That is why we must realize a unified, community-wide strategy to bring safe, affordable housing within reach of all. Impact investing. Through this innovative model, we are investing capital and creating access to economic opportunity, generating both a social and financial return. And finally, flexible funds, which build our ability to work with neighbors and address needs and opportunities as they arise. Thanks to so many of you who have given, we have raised $34 million towards this targeted $50 million goal. And these dollars are being invested in community to support immediate needs and strategies for change over the long term. Thank you. We hope you'll continue to consider your philanthropy and participation in the Greater Together campaign. Our region is at a turning point that calls on all of us to join together, think bigger, and act bolder as systemic racial and economic disparities continue to inhibit the well-being of our community. Through your generosity, we have enriched our community in countless ways. And through the campaign, we're calling on everyone to help us build a brighter, more equitable future. We invite you to join us by growing your current fund, which enables you to increase your impact as you give to organizations near and dear to your heart, while building the foundation's capacity to advance our community at the local level and remain a national leader. We invite you to co-invest in campaign priorities. Each priority was selected because it addresses root causes on a greater scale. Consider giving or granting to our priorities where your passions and interests align. Again, those priorities are the Thrive On collaboration, early childhood education, housing, impact investing, and flexible funds. Anyone can give at any level. And we invite you to leave a legacy by including a provision in your estate plans directly to the foundation or your fund here. We can't predict the future, but we can ensure its promise. And legacy gifts are a critical tool for us and for you to ensure a brighter future. You can learn more about the campaign by going to our website or contacting your philanthropic advisor. We are at the ready to support you in identifying ways of contributing that align with your passions and interests and can help facilitate granting from your donor advised fund or giving through appreciated securities, IRA, qualified charitable distributions, and complex assets. As the year comes to a close, the season of giving is upon us, and we know many of you grant generously. We encourage you to spend the income available in your funds. We're all here to make an impact, and activating these dollars in our community is an important way to make a difference in the lives of Milwaukeeans. Please be sure to watch your inbox for more information in the coming weeks, and be sure to register for our new donor portal. Finally, we invite you to share your GMF story with others. If you know someone who may be interested in learning more about the Greater Together campaign and the Greater Milwaukee Foundation, please introduce us. As a donor, you are an ambassador for the foundation and our community. We welcome the opportunity to connect with more individuals, families, and organizations throughout our region who care deeply about Greater Milwaukee and who share our vision. I hope building a Milwaukee for all and our opportunity to invest in solutions that help us reach this vision energizes you as much as it does all of us here at the foundation. We can do far more together than any of us can do alone. And now I am pleased to pass the mic over to Mike Miller, Investment Advisor for the Foundation and Chief Investment Officer at Crucial Partners, who will share insights on the Foundation's investment performance. I know he looks forward to hearing from all of you, so please feel free to share questions in the Q&A at the bottom of the screen. Take it away, Mike.
Thank you, Kristen, and good morning, everyone. It's a real pleasure to be here with you all. I have a really, actually very positive investment report to give, which is nice, particularly when we listen to how many wonderful, wonderful challenges the Greater Milwaukee Foundation is rising up to tackle in your community. And so one of our goals, as you know, and the foundation's goals is to ensure that the endowment assets and the long-term assets that the foundation owns are essentially distributed and available for distribution today, 10 years from now, 20 years from now, 50 years from now. So that's a big part of our strategy, as many of you know. So we'll jump into the slides and go right to the first one, if we may, which is always good to start with the performance. And so that's what we'll do. On this slide, you can see the returns essentially through, I'm going to try to make it a little bit bigger on my screen. I'm sorry for guys, I'm having a little technical issue here. Let's see if I do this. That's so much better. Good. Sorry, I had a little technical issue. I've never used Zoom before. So what you can see here are the returns of the portfolio, which are the blue bars, compared to CPI plus spending. So that's a very critical thing. We'll come back to the CPI quite a bit in this presentation. There's a red bar, which is a 70% global stock, 30% bond exposure. And then there's something we call the custom market benchmark, which is the green bar. What the green bar reflects is the foundation's strategic asset mix over time implemented with just index funds. And one of the main reasons we use that is because it helps the committee decide whether the portfolio is in fact being invested wisely vis-a-vis just putting it all in the indexes. I'm very happy to say, we'll talk about this a little bit more later, that the foundation investment committees never actually had to have a serious conversation about putting all the money in the index fund because the portfolio is almost always, with very small exceptions, done better than the indexes. And that's been very important to both the success we're looking for in terms of achieving CPI plus spending, and it's a critical element of the strategy and one of the very unique qualities of the Greater Milwaukee Foundation. So those of you who rightfully so are skeptical about the ability of anyone to outperform indices, it's very important to note that that's correct. You should be skeptical, and the foundation's been a notable exception to that very strong rule. So just to point out a couple of things here briefly. First thing you can see is actually, first of all, there's a label error, and I do apologize for this. It's not calendar year to date, that first comment. It's the latest 12 months. The numbers are accurate, but it's the wrong label. I don't know how that got past me. But needless to say, the portfolio you can see is up almost in the neighborhood of 12.5% for the last 12 months, which puts it well above CPI plus spending, but behind those other two benchmarks. The main reason for that actually are a couple of things. One is we have a little bit of a value orientation in the portfolio, which has definitely not been helpful in this last 12 months. And two, we have some private equity, and private equity has not been basically being changed. Values aren't being changed, yet we compare it to an index that has public markets in it. So it kind of gives us a bit of an artificial headwind over very big return periods like this. So we're not particularly upset or worried about it because it's short term, number one, which I want to come back to. And two, it's very much an issue of private versus public in the portfolio. If you look at the longer term numbers, a different picture emerges. Let's just break down this into two other groups, 3 years, 5 years, and 10 years, where it doesn't look like much, but I'll get back to that in a minute. But the portfolio is outperforming, particularly outperforming the 70-30 mix and also outperforming the custom market benchmark over those periods of time. What's interesting about that is the custom market benchmark doing so much better than the 70-30 tells you something about the skill the committee and the foundation have exhibited, the investment committee and the foundation have exhibited with regard to asset allocation over all these years. And then the fact that the blue bars above the green tells you what I mentioned earlier, which is that the active management and index funds, we use both in this portfolio, have been very, very effective. Now you go up, but if you look at those periods, a little something emerges that no one likes, which is you see that gray bar has gotten suddenly very difficult to beat. And that's a really, really big issue. This is what we're here to do, is to outperform that gray bar. When we get to 15 years, though, and this is something very important, capital markets and equities and bonds can fluctuate, as you all know, quite a bit, even over 10-year periods. So the longer your period you look at, the better when it comes to measuring your success in terms of preserving the purchasing power, the intergenerational balance of these assets. And so the 15 years is the picture we like the best, as you would guess, because you can see two things here. One is the gray bar. We don't like this part, but it's above the red and the green bars, which means that the benchmarks did not achieve success in this regard. Yet the blue bar, which is the foundation's portfolio net of investment fees, just to be clear, is ahead of the gray bar. So that difference, that spread between what the index did and what the foundation did was game changing, literally game changing. So instead of falling short of our critical, most important benchmark, we actually exceeded it. 20 years, almost the same, but not quite. You can see that the same story with the red and the green struggling to keep up with the gray. The blue bar has its advantage again, but not quite as good as we wanted. It's just a little bit shy. Now, one of the things I will tell you I think about a lot is the fluctuation of returns the things that we do that actually have long-term payoffs. And I have to say, today in the portfolio, one of the things we're really excited about, the portfolio is doing quite well, but it's also got gigantic amounts, of our opinion, of embedded value, unrecognized value, i.e., things happening inside the portfolio that we're not getting paid right now yet for, but we will. So closing that gap does not feel like a particularly big mountain to climb for us. So we're not particularly worried about it, but nevertheless, we are behind from over the 20 years. So take a look at the next slide, if I may. So I mentioned something before about short-term versus long-term, where you break out the buckets. If on the prior slide, one of the things that was a little misleading about it, other than my labeling problem, which is still here, by the way, it still says calendar year to date, it's still 1 year. Outside of the labeling problem, the other issue on that graph is it makes the calendar year to date, which is what it says, but the 1 year in reality returns look so much more important than the long-term returns. And it also has an issue where it doesn't really show the true power of the outperformance that you can generate over time. So this chart really takes that and puts it in a very different perspective, very important, which is to compound. So those numbers before were per year. These are cumulative. So you just compound them out. You don't exactly add the numbers together. There's more to the math than that, but it's essentially compounding the returns on the prior page. So these are the exact same numbers, but you're not looking at them per year anymore, is what I'm trying to get to. So the first thing you'd see here, first we'll take a look at, again, the 15 years for a moment. So now you see that the gap above CPI plus spending is how far below those index are. Long way to go to catch up to that number. We don't. We have relatively small amount to catch up, frankly, from our way of thinking about it. So we can do that. The other critical thing here is when we do things at the foundation. I mentioned before that we do things with a very long-term focus, and we expect to get paid someday, and very, very non-specific about that. And the reason we do that is because we think the best returns come when there's uncertainty about when you'll get paid, as long as you get paid for something that you're doing that's smart in the portfolio, whether that's a company that's changing its management, whether it's new products, whether it's all kinds of different things that managers in our portfolio are looking for that the market doesn't recognize. That big payoff down the road issue is so important because of what you see here, which is that even the 3 years, those returns look like nothing compared to 15 years and 20 years, because they aren't that important compared to 15 years and 20 years. We need to compound capital at high rates of return for long periods of time, not for short periods of time. We're happy to have the short, don't get me wrong. But when at the end of the day, the decisions that the investment committee makes are all geared towards long-term outcomes, long-term outcomes, long-term outcomes, because those are the things that really have power in terms of taking your capital and other philanthropic capital in the hands of the community foundation and making it really work for your community. So we turn to the next slide. So the next thing to think about is just how you're doing compared to other endowments and foundations. I will tell you this: if every endowment and foundation in the world, or country in this case, mostly the US, could outperform CPI plus spending, and we were at the bottom of that group and still outperforming CPI plus spending over a long period of time, I think I would actually think that was a better outcome than other outcomes, because that's what we're really here to do. Winning the horse race is really nice, and we're happy to win it, and we do try to win it. Just to be clear, we're very competitive, but at the same time, that's not, again, winning the horse race and being below isn't the goal. So here, what you're looking at is the horse race, which is other endowments and foundations. There are about 1,000 of them in this universe. It's collected by an outside firm called InvestMetrics, so it's not our data. And if you look at the green bar in the middle, again, now we've got the label race. You can see latest year. Those are the returns on the top line for the foundation. Those are just the numbers you saw on the other pages without bars. And then underneath that is InvestMetrics E&F median return. So for those of you who don't think about what a median is the middle of a distribution. So half did better, half did worse. And that's essentially what you're looking at there. So you can see, first of all, the portfolio outperforming all those medians. So even over the year, when we underperformed our benchmark, we're outperforming the median endowment foundation, which is interesting. Now look at the gray bar above, where you can see the ranking. So there are 4 potential numbers that could appear on that slide. Fourth, which is the bottom 25% of endowments and foundations. Third, which is below the median, but not the bottom. Second, which you do see here 3 times, which means you're above the median, but not the top 25%. And then first, which is where we love to be, which is top 25% of all endowments and foundations. And it's kind of interesting. I will admit a little frustration here. First of all, for those of you who've been on these calls before, been on these, used to be in person someday, maybe again, what you'll notice is that this isn't bad. We've had thirds and fourths appear over the short periods of time in the past, and I really don't love those outcomes, but we actually know when we're doing smart things that other people just aren't doing, we're fine with it because we know what's going to happen in the end. We'll have our day in the sun. Nothing like that here, but what you can see is the seconds. The thing I was about to say, a little frustration is for the year, because we're basically half a percent. I think we're ahead of about 65% of the endowments and foundations out there, so it's fine. It's good enough. For 3 years and 5 years, we're just barely below first. So I think in both cases, we outperformed 72 and 73% of endowments foundation, which is just a slight below that 75 you need to get to. So they're close, but no cigar. So we have to live with that, of course. 10 years, 15 years, top quartile, and then 20 years, top decile. So it's kind of interesting when you think about this. So go back to what I said before, which is, wouldn't it be great if everybody could succeed? And then who cares where you rank? Because you're doing what you need to do as a community foundation, which is you're compounding your fund holders' capital and the agency capital of all the different folks that are invested with your pool at exactly where you want to be. But in the real world, unfortunately, that's not how it works. It's much harder than that. So remember that 15 years column before where I showed you that beating our benchmark was the game changer. Well, it's even worse here. This is a 1% per year gap. So remember, the median is half. So half of the endowment foundation community did worse than this, which means that over the last 15 years, not only did they not exceed CPI plus their spending rates, they dramatically fail. And they've actually, in many ways, may have permanently destroyed their capital. And I know that's a very strong word, but then when you get to these kinds of time periods, you must generate these returns or else you have some really big problems. And for 20 years where we fell short, remember that we fell short, we were still top 10% of endowments foundation. So that's in part because inflation is definitely become a bigger problem more recently, as we know. It's also in part because it's hard. It's hard to generate CPI plus 4.75 or 5% a year. It's possible, and we've shown how it can be done over 15 years and almost over 20, but it's not easy. And that's one of the things that inform our strategy. So when you hear some of the things I say in these webinars, sometimes they might sound like, oh, that sounds hard to do, or that sounds a little odd to do, things that we don't do I don't hear people doing that much. There's a reason we're doing things differently, because different is the key to success, as long as it's smart, of course. Let's go to the next slide. So let's talk about the philosophy here. Critical part of this, and no offense to the investment community, incredibly brilliant group of people, incredibly hardworking. We give them 100-page books every quarter plus, and so we certainly work them. But at the end of the day, a successful long-term strategy cannot be built on acts of genius. It has to be built on good fundamental blocking and tackling and very simple stuff. And that's all we're doing here. So rule one, we think long-term. So at times like this, for example, when the world is definitely in a very difficult place in so many regards, can't even list them all, we stay long-term. When things are great and people are happy, let's look forward to those days again, we stay long-term. And so these things are really important. It's tempting to think about your day-to-day existence and let that bleed into the portfolio here a little bit. We don't do that, which gets to the second point. No attempt to change strategy based on current conditions or near-term outlook. So I want to emphasize that. The investment committee met last week. We did not have a single moment spent on whether there be how high will inflation be this year, where will the market end up this year, when will we have a recession. None of those things were discussed, not because nobody cares, because we all care, they're part of our day-to-day lives, but because we know they have no impact whatsoever on a good long-term investment strategy. And I know that's very kind of probably some cognitive dissonance for many people, because a lot of what you hear and you consume, no fault of your own, is all about that stuff, and that stuff isn't meaningful. Last but not least, we're very diversified. Diversification is the critical element to the world and to being a good long-term investor, because at the end of the day, investing is about risk-taking. It's about hopefully thoughtful, controlled risk-taking. But when you take risks, you will make mistakes. And when you make a mistake, it cannot have an outsized impact on your overall return. And that's a critical part about being diversified. So we'll go to the next slide. So speaking of diversified, this is the strategic asset mix of the portfolio. It's reviewed every year. There's going to be a really interesting review coming up in January, February next year when the investment committee meets again, because interest rates are higher, but I'll come back to that in a minute. So what you can see here is we're very long-term oriented. So 62% of the portfolio in public stocks, another 21% in private equity and hedge funds. So that gets us to 83%. 12% in regular old bonds for the most part, and then 5%, as Chris was talking about, in mission investments, which is just a really exciting part of the portfolio. It's been actually a great contributor to returns, because it's very stable and very, very, very important and powerful stuff. What you can see here, though, is that this is a very diversified mix, again, as I mentioned. So it's global. And we're going to spend a lot of time later, if you don't mind, hopefully you won't mind, talking about why you shouldn't just buy the S&P 500 and be happy. That's not what we're doing here, as you can see. And let me be clear, we've never done that here. So those returns you saw earlier, those high rankings do not come from just putting all the money in one country, even if it's our country. The last thing I'll point out is that we keep the portfolio very close to this mix. There's tremendous generosity in your community. And so we frequently have cash to put to work. And we do so, we put it to work by just bringing ourselves back to these targets. It does not take any kind of active genius again to get us to what we want to do here. And the second thing I'll say is the committee does review this annually. They don't change it every year, so there's a chance we'll come back next year and there'll be no change. I have a funny sense there'll be a change this year, but we'll see. And as I mentioned earlier, higher interest rates are really, really important on many levels. One of which is, as you guys know, everyone knows, means the returns on bonds just got a lot better going forward than they used to be, and that's really important. We're not making it, just to be clear, no one should run out and buy a bunch of bonds right now because we're suggesting bonds are the best thing to ever do, but they just got more interesting is all I'm saying, and it might be really interesting for a long-term investor. But I don't want to get ahead of the committee because they're in charge, just to be clear, not Ursula, not me. So we'll go to the next slide. So I mentioned earlier that managers success, we've had a lot of success with managers, and I think this is really important. And I just want to point out a few things that we do that are a little bit different, maybe, than others. The first is IBAR. We will not show any interest whatsoever in a manager who can't generate significant premiums to a benchmark. So let's say your benchmark's up 7% per year, and a manager is up 7.5, 7.6, 7.7, after their fees. So it's not bad, but we're not interested. We're not interested because of two things. One, that's not enough for the risk we're taking that they might underperform or likely will underperform. The second thing is we're going to make some mistakes picking our managers. So we need our winners to outweigh our losers. And that's what you saw earlier with the outperformance compared to the index. It's not that we've been perfect. We've picked managers that have not worked out. No one disastrous, of course, but still underperformed. And when that happens, the winners need to be enough to overcome that hurdle. And that's what we've had happen here. So we're looking for very high bars when it comes to returns. The second thing, we need to see an edge. The manager has to have something that they're doing differently. I met with a manager yesterday, in fact, and this manager was explaining their investments in some very popular names. I'll leave names. I don't want to, I don't want to say anything negative about anybody. And I was sort of like, yeah, what do you know that everyone else doesn't know? And that's a problem. You have no edge. So people need to have an edge. It might be that they're specialized, like they're healthcare focused. It might be that they're much more patient than other people. It might be that they're concentrated, i.e., they only hold 10, 12 stocks, not 20 or 30 or 50 or 100. And the last part has become increasingly important. As we all know, the Magnificent Seven, I don't need to define that, I guess, and that's where we're at this world today, are just dominating everything else. It's getting a little ridiculous, I have to say, just when you look at the earnings of the Magnificent Seven compared to their actual company size, they're way out of whack today. But putting that aside, it puts a huge, huge burden on investment management firms because they can't keep up in many cases with it. And so it's hard not to get upset, and it's hard not to make investment decisions that are not based on what you think is best in the long term, but based on what you feel right now. So we spend a lot of time making sure the managers in this portfolio are quote unquote having healthy reactions, both emotionally and intellectually, to what's going on in the markets. And then last but not least, we avoid risks that we think are just you don't get paid to take. So I won't go through a litany of risks. This is just a small sample. There are many, many more. So next slide. So I mentioned that before, that we're looking for different perspectives and looking for, at the end of the day, one of the things I think that has been the secret to the foundation's success and our success with the foundation has been the idea that we understand that investing is about people. And so what we want and what we're looking for, and I mentioned this way back at the beginning, we're looking for investment firms, investors, people who run these firms and make investment decisions, who can do this thing, which we call, and we wrote this in the middle of the first bullet point, who have a variant perception. What a variant perception means in English is that I or you see something different than other people see. And sometimes it doesn't come from being it doesn't come at all from being smarter than other people. It just comes from having a different perspective and saying, hey, you know what about this? Or what about that? We've all been in rooms where people ask, really interesting questions or say really interesting things that we have not thought of ourselves. And that's because they have a different perspective. And that perspective can come from a lot of places. It comes from the differences in age. I think, younger people have different perspectives than those of us who are a little more mature. Where you live in the world, we do a lot of global travel, and I'm still fascinated to this day the degree to which people sitting in Asia or Africa or Europe or South America or the United States see things very differently from each other. It's really, really quite fascinating. And so variant perception comes from that. And last but not least, it comes from gender and ethnicity, because these things influence life. They influence your family experience, your day-to-day living experience. And all this is about being people. And so the beautiful thing, if you're a risk taker, as I said earlier, and you're trying to invest capital for the long term, I need those varying perceptions. We must have those varying perceptions because that's how we beat the markets over time. So the Greater Milwaukee Foundation has had a huge commitment. You heard this from Kristen before, to diversity. And the beautiful thing is, diversity isn't just a thing you do in your portfolio, it's a thing you must do in your portfolios if you want to achieve the results the foundation has achieved. So we go to the next slide. This is our report card on diversity. We started doing this 3 or 4 years ago, I want to say maybe five. And there was a goal of getting to actually 25% by 2025. It is 2023, as you can see, and we're at 24.6% and rising. And so we've gotten there, and it was a walk in the park. And it was a walk in the park, despite you see at that first statistic, which is only about 0.9% of capital is actually managed by diverse individuals. And we're at 24.6%. So that tells you something right there. And again, this has been, like I said, this is what we do. So this is not complicated at all. There's absolutely nothing about that this must happen. And if it didn't happen, I think the results would be weaker. So we'll go to the next slide. So let's talk about the world. By the way, the diversity of our managers, the diversity of the people around the table, the Greater Milwaukee Foundation, the thinking that we do and the committee does are really, really important because the world is getting very complicated. I'm leaving out all of the things that most of us think about and should think about a lot, which is geopolitics and war. And, my gosh, it doesn't seem to end. So let's just keep our focus on this very narrow sphere, which is the economic world and the financial markets world. So three big points. First point, higher inflation. I know I saw this morning that inflation came in at a lower number than people hoped, and everyone's excited and happy. That's great. But inflation is higher than it's been. It's probably going to stay higher than it's been. Nothing dramatic. It's not going to be 7% a year. I don't think we're going back to the 1970s here. But having 3% inflation, which is higher than it's been for quite a few decades, is not nothing. It's really important. Particularly because it's changing the way central banks are behaving. We've had this thing for years called quantitative easing, which is essentially central banks like the Federal Reserve buying bonds in an effort to depress interest rates, in an effort to stimulate people to spend money and have economic activity. We've got a long debate about whether that was a good idea or not, but it's ending. At least it seems to be ending. Let's hope. And so what that does is it changes things in a really, really, it's a seismic shift. And so interest rates will probably stay higher. And that creates risks. It creates problems because not every company can now get money when they want to. And that makes things really hard for things. And so capital scarcity is what we call that, which means that everybody can't have what they want. And when that happens, people make choices and it's game changing. And one of the things we worry about is the Magnificent Seven, or something like 28% or more of the index right now. So 7 companies, this index is getting increasingly concentrated. Admittedly, companies that people absolutely know well, trust, and are very strong businesses. But at some point, the market has this weird thing it does, which is very, very, very challenging for a lot of people, which is it just gets too excited about something. And even if it's a good idea, it's not a good idea as an investment because it gets too exciting. And we're not suggesting the Magnificent Seven are all bad investments. Some of them are going to be very good investments. In fact, some of them won't. What we are suggesting is that it's odd to us that in a world which is so much more complicated on so many different levels, that we can have this group of stocks that are trading as though the world's just great and is going to stay great forever. So it's just a little bit of an oddity as far as we're concerned, which gets to the next slide, which is the things that, I was trying to think about this slide a different way. This is a new slide for those who haven't seen these before, which is how do we impart whatever wisdom we've gained? So I've been doing this a long time. It's my 37th year, 38th year. And what have we learned? So there are 4 things I thought would be fun to just briefly mention to you today. The first is there's a book years ago called Wall Street's Random Walk. That's the Random Walk Down Wall Street, excuse me. And what the book was about was the fact that markets are not predictable. Markets are on a random walk. So it's kind of like, if you think about somebody who's trying to go, from the foundation's office to the light down the street, but instead of just walking a straight line to that light down the street or to their car, let's use a better analogy than that. They instead just kind of go on some random, weird, circuitous path. They eventually get to the car, but it's a strange path, and it's actually personally how I walk around. So if you've seen me in Milwaukee airport and some person who looks like this crazy person doesn't seem to know what they're going, that would be me. And it's the random walk. And the reason it's important is because if markets are on a random walk, then every sentence that starts, well, I think the market's going to do this in the next 3 or 6 months because of A or B or C is by definition, wrong or just lucky if it works because it's random. And if it's random, you can't predict it. That's the whole definition of random. So the reality is that it's really interesting that people don't, still to this day, don't quite appreciate that fact that it's random. And that's why when things happen and someone says to me, like, hey, were you surprised the market did X? I was like, nope, it wasn't because I had no expectation for what it would do. It could have done that, or it could have done something different. It's just too complicated for anyone to predict it. So that's really, really important. Second point, relative valuations. What that means is, I mentioned the Magnificent Seven before. So they're very, very expensive today by any reasonable measure, and that might be fine. They might be worth it. But the reality is that you're usually better off buying things when they're cheaper and less popular, which gets to the third point, which is that popularity is not your friend. Despair is. I know that's a. You see why I'm so much fun to hang around with. When things are popular, usually the prices are too high. And so I always think it's just a good rule of thumb to keep in mind for your personal portfolio is that if you own something and you're reading, everywhere you read, people love it, you probably need to be thinking about maybe not being there anymore. When you find things that, again, well researched, not just anything that people hate, that could be an amazing investment. Some of the best investments I've ever seen clients make have been in things that people did not love. In fact, when they do get loved, they get sold. And that's a beautiful thing. And last but not least, cycles have not been repealed, which is really important. Like right now, we are in a very long period of time of dominance for US, particularly US large companies. And so if you invest in those heavily, you kind of, one of the things you're basically saying is that this cycle isn't going to turn. At least not going to turn anytime soon, or you're going to figure it out before it happens, neither of which is true. So we go to the next page. Let's talk about cycles a little bit, whether we have to, what do we do with this stuff? I mean, how do we actually survive these cycles? Because they're tough. So this is a look at the EFA index. So EFA is an index of basically non-US developed markets, which would be Europe and Japan, basically, to keep it simple. Europe, including the UK. So the light blue you see at the top is when EFA over rolling 5-year periods since 1970. So the graph says 74 at the top. That's the end of the first 5-year period. So when EFA is outperforming the S&P 500, it's the light blue at the top. And when the line goes below the line there, the darker blue, that means EFA is underperforming and the S&P is outperforming, to be more clear. So one of the things you see here very clearly, there have been cycles. They're long. And if you look at the far right, you can see the big problem, not problem, but good thing if you're an S&P investor today, which is that the index has dominated EFA, for a long time. Remember that first data point is 2010. So that's, we're into 13 years of this now. It's not quite the longest or the most impressive because the 90s were even more impressive, as you can see there to the left. But needless to say, this has been going on a long time. When people say, when's it ever going to end? The answer is who knows? But we do know it will because it always does, and it will end again. So go to the next slide. Same slide, except this time we've substituted the emerging markets. So that's China, South America, India, Central Eastern Europe. Those kinds of places are now in this slide, and the same basic picture. You can see this is a little bit shorter. That's why, because the index started later. And you can see the light gray, light blue is again, same thing. EM outperforming, dark blue, S&P outperforming. So here's the challenge. So Mike Miller and Crucial and a lot of other people maybe do or don't say, hey, this is all cyclical. Don't put all your eggs in the one basket, i.e. the US, because it's cyclical. That's true. However, that's exactly what I'm saying. It gets a little tougher for Mike Miller's argument because of the following, which is that if you go back to the beginning of each of these indices, so EFA to 1970, the EM index to 1988, the problem you have if you're trying to make my argument is that the S&P has beaten both of those indexes by about 2% per year from the beginning of the index to September of this year, which kind of proves the point of people say, why do I need to be diversified? S&P's done great. As US companies are global, I'm getting global exposure and I'm beating the index. I don't have to deal with currency risk. I don't have to deal with any of the governance risks or other things outside the US. What's your point? It's a really good question. I really hate that question because it's such a good question. So we sought to figure out something, and we went back and did a quick back test to kind of see something that we thought might be true. So let's go to the next slide, which is that, and this is a little complicated, but it's all footnoted here, so you can read it later, but I'll give you the quick version of it. We thought to ourselves, okay, that's interesting, but there's something about that argument that bugs us. The first thing that bugs us about it, by the way, is if you measure that inception to date measurement for the 50 plus years for EFA and the 2%. If you'd done that like 6-7 years ago, the answer would have been much different. And what if you do it 6 or 7 years from now? And the answer again is much different, i.e., worse for the S&P. How do you account for that? Is one problem. The second problem is just having been students of markets all these years, we've noticed that markets have good years, they have bad years, and what you can see though in those slides is the S&P's had more good than bad for sure, and that's why those graphs look the way they do. So what we did though to try to figure this out is we ran a really simple back test. And we said, okay, let's in 1970, because we didn't have the emerging markets yet, we'll put 60% of a portfolio in the S&P, 40% EFA. And then we got to 1988, just to be clear, and I'll get to another point in a minute. We added EM at 10% to that basic index, basically. So then it was 55, 35, 10, 55 S&P, 35 EFA, 10 emerging markets. And then we did something that any good contrarian would do. At the end of each calendar year, we said, well, which index did the best of the two for the first 18 years or so, and then the three from 1988 to date? Whichever index did the best, we took 5% away from it and gave it to whichever one did worse. Now, in the case of emerging markets, we had the wrinkle. We just only did 2.5%, only because people wouldn't do that. So we're trying to be realistic about what people would actually do in a portfolio. So that was it. So we call it a contrarian global diversified strategy, i.e. it's all these indexes. We put some constraints around, so the S&P can never be less than 50 or more than 80, for example. So all kinds of things just to make it realistic, because no one's going to own portfolios that are 90% EFA, for example. We did all that. And then what we did is we said, we just measured the 10-year returns. So take a look at this graph now. So the red line are the rolling 10-year annualized returns, 1970 to 2022. We ended it in 2022 because we don't have 2023 yet to judge. Soon we will. So the red line is that global diversified contrarian mix. The green line is the S&P 500. When you look at this, something very strange starts to come right at you. So it's like, wait a second. If you look at those graphs before, and Mike just said 2% per year more out of greater performance of the S&P, that red line's above the green quite a bit. It's kind of shocking when you think about it. And so, what's going on here? And then what's going on here is that this whole idea of strategizing around take from the most and give to the weakest is really, really powerful stuff, because markets do fluctuate inside of these 5 and 10-year periods, and you're capturing return by essentially, selling your winners, buying your losers, and that strategy works. Now, it hasn't worked if you look at the right-hand side of the page very much over these 10-year periods that ended in 2017, 18, 19, 20, 21, 22. So it doesn't work all the time, but it works most of the time, which is really interesting. So go to the next slide. And let's go full circle. So I started this presentation by showing you how the foundation had outperformed its CPI plus spending objective, basically in the last 15 years. We were in the running for 20 years. We're not there yet, but we'll get there. And most endowments and foundations didn't. Our benchmarks didn't. In fact, they didn't even come close. Now, the key thing, if this is what we all care about, is we must have high returns on public equities. You saw earlier that we have more than 60% of the portfolio in public equities. So if the public equities don't produce big returns, we have a major problem. And so this is one of the reasons that, for those of us anyone who has a ton of their money in essentially the Magnificent Seven plus a few other stocks, i.e. the S&P 500, I worry about how you're going to get the returns you need, at least as an endowment, to generate the 9% plus you need from your equities, which I just threw a number in there, which I wanted to identify. So why 9? So we picked 9% as the bar. Like if we get 9% from our public equities per year for 10 years, we're going to be in the mix. And I think that's really, really important to think about it that way. If you get 6% or 5% from your public equities, you're going to be way, way out of the mix and way in trouble. So 9 was the bar we set. And then all we did on this last little table at the bottom is we said, let's count up the number of 10-year periods where the S&P 500 outperformed 9% per year. Because at the end of the day, every 10-year period matters, right? None are more important than others. And so S&P did that very nicely. 2 out of 3 times. I'm rounding up a little bit. So 64% of the time, the S&P did that. Second line, haven't talked about this, but let me give you what this is real quickly because it's also important. Static diversified global portfolio. What the heck is that? That's that 60-40 portfolio I talked about, S&P 60, 40 EFA, 55, 35, 10 once we get the emerging markets in 1988. That's just do that index every year, no changes. So no contrarian, take from the highest, give it the lowest, just skip that part. And you can see that did worse 59% of the time. And that happened because the indexes did were weaker than the S&P. You were better off than the S&P. That's what that proves. But now look at the last line, which is this diversified portfolio of ours with the contrarian little mix in there again. And remember, very simple. End of each year, all I do is take a look. Nothing fancy about this. 73% of the time. This is a massive issue. 2 out of 3 times is fine, but why would I do something where my success rate is 2 out of 3 times when I can have a success rate of 3 out of 4 times? because that's the promise we make to you. And that's the work we do every day here on behalf of you and the other donors and the beneficiaries of this foundation's assets, which is we need to achieve these goals and we need to have the probabilities be as high as possible. And this is a critical, critical element. A global diversification with a contrarian tilt, which is something we do at the asset mix level and at the manager level, is super important. This is a little more formal. We don't have a formal 5% shift, just to be clear, but this is really important. So last but not least, last slide. Here's our strategy. We only do things where we have a high probability of success. So that's why you did not hear me predict today when we go into a recession and what we would do about that. You did not hear me tell you where interest rates would be. Again, I wish I knew. We have guesses, but we don't invest this capital based on guesses. Two, this massive, $600 million, Kristen said before, of assets gives us the ability for scale, stability, and a long time horizon. We love index funds. I know I don't sound like I do, but we actually love them, but they have to be balanced with compelling managers. And then last but not least, and this is the part that, especially when the world gets complicated, I think about all the time, which is that when things get complicated, i.e. markets get volatile, this is usually really good news for long-term disciplined investors like the foundation. So that's the silver lining in the challenges of today, is that this is probably the precursor to something pretty great, but we're gonna have to be patient to see it through. So thank you so much for your attention. It's been wonderful to be here with you. I see Anne Marie back on my screen, so I think we're going to go to the Q&A now.
Thank you, Mike, for this informative presentation and, of course, your deep commitment to helping us steward and grow charitable dollars for our community. Really appreciate it. I think we do have a few minutes for questions. So let me get right to those questions. If you do have questions, you can text them to 414-335-1871 or enter them at the bottom of the screen at the question and answer section. So Mike, first question, 2 parts. Can you say more about what you mean by destroying capital? And is there a tipping point for access to investments?
Yeah, so by destroying capital, that's very, well, there's a couple of things you can mean by that. So I'll tell you what I meant, and I can tell you what you could also mean by it. So what I meant is if a foundation or endowment wants to preserve the purchasing power of its endowment, of its long-term funds, and that means that I need to earn 8% a year or 7.5% a year to do that. And instead, I earn 4% a year over 20 years. I'm so far behind what needed to happen that I've essentially, destroy is a strong word, but I put myself so far behind, there's almost no hope of catching up. And so I call that destroying, because you had something and now you don't. And I think that's one of the things that we talk about. The other investment part of this, though, which I do think is important just to mention briefly, is that destroy also means when you invest in something that goes bankrupt, for example, i.e. you never get the money back, or you overpay for something, which is something people really, really, really struggle with, which is, everything. So if you invested in Cisco Systems in 1999, great company, very important part of the future, you've never, ever gotten your money back, and you never probably will. And so that's destroying. That's what happens to popular companies sometimes, not always. When you get to that, that's also a destruction of your capital. And so we really think about that. And let's just put that in contrast to, I buy a stock, I have a manager who buys a stock that goes from $70 to $30 a share. And that's what I show you in these investment reports you see all the time. Everything's publicly traded. It's mark to market, we call it. But what if that stock 5 years from now is trading at $300 a share? I didn't destroy anything. I had the $70. Yes, I had to sit there while it was at 30, but it was going to 300. And so I destroyed nothing. And that's a very big difference between those two things. And so I think that's a critical part. That's what we mean by destroy capital. On the second part of the question, I was so busy on destroying capital. I forgot the second part. Sorry.
Is there a tipping point for access to investments?
Well, in terms of like a minimum size, I assume that's the question of dollars involved. I don't think so. I mean, I think there are some great index funds out there. There are some great mutual funds out there. I think that a lot of people can do a lot of things with whatever capital they have. I think that's really important. But I would say access to the kind of investments the foundation's making, yes, there's a tipping point. I don't think anyone can invest even remotely in this strategy unless they have at least $100 million. Probably might be able to get a little lower than that, but a lot of this is tough to access. And so, that's one of the things we spend a lot of time on is making that happen. And the foundation's reputation and its mission they're extremely significant when it comes to how you make that happen.
Thanks, Mike. So another 2-part question here. Do you think some of the craziest craziness around the market has been influenced by past cryptocurrency craziness? I'll do one at a time. How about that?
Anne-Marie's figuring me out real fast. Yeah, one question at a time, Anne-Marie. Thanks. Um, That's so hard to say. It could be. Yeah, there's a lot of speculative fervor out there. Crypto was certainly one manifestation of that. Yeah, maybe. It's so hard to know. I think a lot of the market craziness today that we're talking about depends on every. No, of course, whoever asked the question, I might have a different definition of what crazy means exactly because it's all eye of the beholder stuff. But with that said, um, I think the craziness in the market actually more likely is due to two factors. One is just how much passive management there is. And that's not an attack on passive management. But what it is a passive management strategy just buys the market, which is exactly what it's supposed to do, by the way. That's exactly what people want. And that's cool. But it doesn't really make any distinction between whether a stock's too expensive or too cheap. It just buys whatever it is. So that sounds stabilizing. But the reason it's not always stabilizing is because it used to be more people looking at stocks and saying, oh, that's too low a price. I'm going to buy that and I'll buy less of something that's expensive. But the indexes don't do that. They buy whatever it is. And so you've taken away this shock absorber mainly because you've just had money flow out of these managers into the indexes. And some of the managers shouldn't have been managing money, but I'm not attacking the indexes. The second thing happening out there right now, which is really important, and I think is really kind of the icing on the cake on this issue. So you've kind of destabilized the markets because you've removed some of this active management. And then what you've done is you've added these what we call them multi-manager, multi-asset class shops, which essentially are multi-strat. So these are, I won't name names of firms, but there are firms out there that run hedge funds, and essentially they allocate the capital to 1,000 people who manage money inside these hedge fund complexes, and each one of them has a pretty simple mandate: make money and never lose money. And so what they do is they're incentivized. They're smart people. They're incentivized to be very short-term oriented. So when the stock starts to drop, what do? They get the heck out because they don't know how much further it might drop, and it might lose their job, and really literally lose their job if it doesn't come back quickly. So that further destabilizes the system. So I think those are the two key factors that are really making stocks be, they're acting in very extreme ways. So the question is spot on as far as I'm concerned. Part one, sorry.
That's good. The second question then is, and I'm gonna not do well with this, but did the Bankman-Fried trial take some of the gas out of that balloon?
What was the last word? I'm sorry, back and free
Out of
trade?
the balloon?
Out of the balloon. No, I don't think the trial did. I think the collapse of FTX did, for sure. This is the Sam Bankman-Fried trial. I'm sure the question is referring to. I think that definitely put a pall over some of the optimism around crypto, and so it's challenging. And crypto is a complicated subject, so it's hard to know. But I don't think the trial was that big a deal. I think the collapse of FTX was a very big deal for crypto.
Okay. And then I think we have two more questions here. There's a lot of talk about China's economy slowing down. How will that impact global investment opportunities?
Yeah, ooh, that's a good one. I was just there actually about 6 weeks ago in Hong Kong, not in mainland China. And what was really interesting, I have to say, this is why we like to travel. I was struck by how vibrant Hong Kong's economy felt, which is interesting because that was not what I was expecting because of what the question's spot on, by the way, about what's happening. Now, the first reason is there's no such thing as work from home in Hong Kong. First, people live in really small apartments, so they don't want to work from home, and they just don't. In fact, I think work from home feels like it's becoming everywhere I go in the world. Work from home is very much a U.S. thing. It's very interesting. It's not very prevalent outside the U.S. from what I've seen. Back to the question though. The Chinese economy slowing is an issue. I think a bigger issue, though, is the ongoing and growing geopolitical tension between the U.S. and China. I think this idea of a bipolar, multipolar world is really complicated for investments. It's got inflationary factors behind it because now things can't be made in the cheapest place because it matters what that place is. Two, obviously, you have this. We keep getting into new military aggressions, and Chinese government should not be trifled with on that subject. They're very capable of military aggression as well. So there's a lot of different things that are happening that really, I think, make it very complicated. I will say the one thing we're sure of, if we look at some of the data, is that Chinese domiciled companies, the good ones at least, are extremely inexpensive today. And they are because a lot of capital has left China, and a lot of U.S. capital just doesn't want to invest there. And I totally understand that. It's a really fascinating investment question today, which is do you put, well, we don't have very much in China in the portfolio, to be clear, but do you put anything in China because it's cheap? And some of these companies are great businesses with a gigantic growing economy still. I mean, it's historically, the reason people went into China are still largely true. But now it's just, whew, it's messy. And that's what makes investing kind of interesting sometimes. So yeah, there'll be opportunities. There's tons of risks though. And I think that's what people are justifiably worried about.
Okay. Then the last question, how do you assess that you are a contrarian on a contrarian strategy, given the great number of diversity of managers and holdings?
Yeah, great question. A couple things. So one is the way we do this is really important. We look at two things, many things. The two things I want to focus on. One is we track every single manager's holdings, and so we can see exactly what the foundation holds. So it's like it's one portfolio to us, even though there are all those managers, as the questioner mentioned, and all these strategies at work. So we're very much aware of what the top names are in the portfolio, and any name, in fact. And because we talk to so many people and because we actually see what stock prices look like, you're a contrarian when you have two things that are happening. The first is you look at your top names, you're like, oh, you just have that kind of guttural, like, oh my God, that stock's done badly. And sometimes they're good. And the opposite's true too, of course. A lot of times they're good. So there's partially that when you look at your top names and you see that they're not Apple, Amazon, Alphabet, and Tesla, and you see other names instead. So that fascinates us. And that gives you one insight that you're a contrarian. And the second is the way we do this, I mentioned earlier. So we have managers right now, they're knocking the cover off the ball, like huge returns in 2023, in part not because they own Tesla or Nvidia, but because they own other stocks. There's been a lot of other ways to outperform, by the way. You didn't have to own those names. And what are we doing? We're doing exactly what you might think we do. We're taking money away from them because they've done so well. That's another contrarian thing to do. And then there are other managers. We actually have a manager in Japan that owns some really interesting stocks that stocks haven't really done that well, but the businesses are actually doing quite well. And the manager is amazing as far as we're concerned. That manager will get new money because they haven't lost money, but they've underperformed. So that's another aspect of contrarian investing is the way you reallocate your capital inside the portfolio. The key point of the holdings and what we see the managers doing. So if a manager owns something, last thing I'll be done. Imagine on something that's going through the roof and they're not selling a share of it, then they're kind of breaking one of our rules because if it was good at this price, it's not as good at that price in most cases, of course, not all.
Great. Thanks, Mike. So thanks for sharing your expertise with us today, and we look forward to the next update. At this time now, I'd like to introduce another colleague, Sydney Key. Sydney is the new Senior Director for Thrive On Guest Experience and Strategic Partnerships. She's an experienced real estate management professional and nonprofit leader with more than 10 years of practical and applied knowledge in community building, property management in commercial and residential settings, organizational capacity development, and community-based programming. Sydney's role at the Thrive On is to help build and manage the first floor community hub, creating partnerships among tenants, the community, and other stakeholders to create a welcoming and inclusive space. Please welcome the perfect person to give us an update on the Thrive On project. Sydney?
Thank you, Anne-Marie. It's my pleasure to join you all today to share brief updates on Thrive On Collaboration and Thrive On King. We had a really great summer supporting community events and engaging with our neighbors in Halyard Park, Brewers Hill, and Harambee. The culminating event for our summer being the block party that we held in September. It was well attended by lots of our neighborhood partners and institutions, as well as many neighbors came out and had tons of fun. Children of all ages were there, and we had a really great time. So closing out the summer. One of the most common questions that we're getting right now is when are we planning to occupy the building? And so we are on target and on schedule for occupancy in early 2024. We've got a series of rolling moving dates that are designed to accommodate the various departments at MCW, the foundation's move, as well as the first floor tenant partners and their staffs coming on site. So all in all, we're looking at early 2024 that we're in full occupancy in the building. Another one of those really important pieces is the arts project, which more information will be coming soon. And we'll be able to share kind of the process and the selection and different elements of the artwork that was selected. But one of the things that we heard really early on in the engagement and community visioning sessions was that the community wanted to see art as an integral part of the Thrive on King building, art that reflects the community's values, the composition of the neighborhoods, as well as some of those priorities that came out as top or key priorities for the collaboration. And so our colleagues have been working, Darlene Russell in leading this project, as well as arts consultant Lynn Lucius, and the environmental branding and architecture consultant with Cadler Slater, Whitney Wright. They have been working very diligently to lift up the community voice with that art project, selecting from a very robust RFP process that brought us in tons of submittals from local artists of various disciplines to really bring in that spirit of what the collaboration is all about, working together to create something that's very symbolic, representative of our community and our values. So there's many pieces of commissioned art, as well as a variety of different mediums that'll be installed in the building. And again, more on that will be coming soon as we approach the times that we're moving in. So more will be shared on that community, but that's a really exciting piece of this. And those artists are just tremendous. It's gonna be, in and of itself, an experience to come and visit the building to see that artwork and in the space. It's just, really, really inspiring. Also, again, on that first floor is where most of the art that I just mentioned is going to be housed. This is also contributing to the vibrant first floor community hub that we've shared and talked about, trying to just find ways that we're making that space very welcoming, and in partnership with all of our collaborators. So our first floor tenants, the CG Schmidt team has been really great about helping us find ways that we're working into that space as well. And just establishing what those opportunities and access will be, how the community and our internal stakeholders as well can take advantage of all of the amenities and things that'll be available to us on the first floor community hub. In addition to the community hub on the first floor, we have our tenant partners, which include Versity, the Blood Center of Wisconsin, Maleka Early Learning Center, and JobsWork MKE, which is a holistic workforce development. They've been coming together, finding really great ways to work together, these kind of organic synergies that are developing among them, and we're not even in the building yet. So they're finding ways to collaborate, work together, share information, and really just planning for how we're going to make that first floor community hub engaging for our shared community. So we're really excited about that, really looking forward to what's going to be possible there on that first floor, as well as a to be determined food vendor. So, with the community hub, food brings people together. And so we're really excited for that as it's progressing along as well in that selection. So those are the key points on the updates for Thrive on King. We talked about our occupancy, the community arts, what plans there are for the first floor community hub and how folks will be able to gain access to that. All of that information will be shared in a series of communications in the coming months as we lead up to occupancy. And our teams are just continuing to work together very diligently as we're all planning this heavy lift into our new home. And so for our audience here, I really can't wait to welcome you all to Thrive on King, to experience the community hub and really embody what the Thrive on collaboration is all about. So I'll just close that with wishing you all a joyful transition through this season, and we look forward to seeing you all in early 2024. And that's all for me, so I'll hand it back to Anne-Marie now.
Thanks, Sydney. We're so excited for the Thrive On collaboration. Thanks for that update. I'd like to take a moment to acknowledge the ongoing conflict in Israel and Gaza. As an organization dedicated to equitable, thriving communities, The foundation is heartbroken over the loss of life and displacement taking place in Israel and Gaza since early October. The proliferation of civilian casualties makes this an especially devastating chapter in this complex and long-running conflict. We urge for humanity to prevail over acts of terrorism and war, so all who are impacted by these tragic events, both abroad and at home, can know safety, dignity, and peace. If you are called to direct philanthropy toward hope and healing in communities affected by this crisis, please talk to your philanthropic advisor for resources. Again, if you have any additional questions on what you've heard today, be sure to reach out to your contact at the foundation. Please watch your inbox for our annual email with year-end dates for receipt of taxable contributions and grant recommendations to be paid in 2023. And especially, I'd like to say in this season of gratitude, please know how grateful we are for your partnership with the Greater Milwaukee Foundation. And thank you for joining us today, and have a great week.